afternoon, ladies and gentlemen. Welcome back to another FOMC day. I hope everybody's having an amazing day, amazing week so far. Again, for a lot of you guys in here, long time no see. We were live with all you guys this morning. We're going to have some announcements about that in a minute, but we had CPI this morning. Everything was lower than expected. Market obviously got a nice little movement up there. And we were able to capitalize on that as always. I mean, what do you guys expect at this point? I'm the swing king. I call stocks that are about to explode before they do, and then countless times over and over and over and over and over again, they do. So, guys, let's do it. It's that time of day again. If you guys want to say good afternoon to somebody in the live chat, do that. Make sure you guys do that. If you want to say good afternoon to me as well, let me know. If you guys are new to the streams, obviously let me know as well. I'd love to welcome you guys in here. But as always, ladies and gentlemen, make sure you guys are hitting that like button on the way in. Helps out a whole lot with YouTube algorithms over here. I've been posting a lot of videos for you guys. The feedback on them has been awesome. I know you guys are really enjoying those. But let's see who we've got in here as we start to get ready for Powell. It is going to be a very, very exciting afternoon, which we have a lot of stuff to cover there as well. But let's see. We have Nate, Keyshawn, Trev. Let's see. Todd, Daly, Taylor, Yuki, John, Johnny, Lofty, Eddie, Wayne, Francisco, Wreck-It Ralph, Brosio, Leo, buy or sell. All right, bud, come on now. It's Powell. We're not going to be going through and trying to come on, man. Really? You want to gamble FOMC? That doesn't set gold by guys. Oh my God. How about we do? See, this is why I only stream for those of you guys in what do you call it now? In the courses and everything. We avoid all this nonsense. No, Wayne, you're already in. You're already in. Well, yes, you would if you weren't already in, but yes. But no, you're already in. First Solar, gem trade of the week. When I say I call stocks that are about to explode before they do, here's an example of this one this week. First Solar was on the watch list for you guys. This thing absolutely exploded. I was able to scale out over 100% yesterday, make them free. Was selling contracts over 200% earlier today. And then what are they at now? About 222% on the First Solars. That was awesome. We had GM as well this week. This was an absolutely nasty one. Moving to the upside there. These contracts ran up over 300%. Absolutely filthy. Absolutely filthy, guys. Futures are better than options. That's true for day trading. For swing trading, no. Let's see. Let's see. All right. First Solar is looking really good still. So here's what we have to look forward to going into the FOMC meeting. Now, I don't expect the Powell to be cutting today. How do you have access? You don't have access. How do you get it? You do have access. Because you're all you had the emails. You had SCV Swing Kings, the Twitter account. It got sent out in, and then it's also in the video section of the curriculum. Like I said a million times. Sell gold in 10 minutes. I actually like gold right now to the upside. But my thesis on it is going to be a lot different than a lot of your guys's. If I'm ever going to trade something like a gold, a metals, a commodity, it's going to be based off of a macro thesis. How far out were those contracts on First Solar? I have the 330s for next week. So we have about 22 minutes or no, 12 minutes. Sorry. Until we get the interest rate decision. I do not expect Powell and the Fed to be cutting rates today. But I do think that it is possible that we do get a July cut. We have GDP growth slowing. You have unemployment going up. You have inflation coming to the downside. You have the consumer being very, very, very weak. A lot of these things are pointing to we're getting closer to the time where we could be expecting rate cuts. So, and yeah, I mean, we could do a little announcement here too, guys. You guys all know that the 50% off deal to all my education, where you get the list of stocks that are about to explode before they do, the 3 times a week private live streams, both the educational curriculums, with the day trading mastery course and Swing Kings course. So right now it's all waitlist only. So when you the link to join the waitlist, guys, is on shortthevix.info. Now, there's about 50 of you guys on there right now that are waiting to hop in. I'm probably only going to be accepting about 10 of you guys, and I think I'm going to open up a couple of spots this weekend. And each time that I open spots, the prices are going to get a little bit higher to what they should be because it's still heavily discounted what I'm going to get. It's going to be basically a 33% sale this weekend. For you guys that do want to jump in, all you have to do is input your information, just your email on the shortthevix.info website. It's pinned at the top of the live chat there. And the reason why there's a wait list, guys, and I decided that I didn't want to just increase prices to some ungodly number that all these other morons are out there doing. Because one, their information and the way that they trade is far inferior to what we do. But I give all of you guys one-on-one access to me to make sure that all of your questions are answered so that you can fully understand how powerful the strategies are because of how powerful they are. So I'll probably be open up about 10 spots this weekend for you guys that do want to hop in. So if you guys are interested in that, shortthevix.info is where you go to do that. It's also pinned at the top of the live chat there. So first solar coming down, GM's moving back up. That was a gem. We had what was the other one? PLD was another one. This was a really good one. So I know some of your options on this thing were up like 180%. That's awesome. I wasn't in this one, but it was on the list that I sent you. I mean, you guys know, everybody that's been in the streams, the private streams, knows the exact reasons as to why I wasn't taking any more trades. I had 3 trades this week, 3 big winners. We had Ford well over 100%, GM well over 300%, and then FSLR that is currently sitting it's probably right around 200% right now. So to me, I didn't feel the need to take on any additional risk going into CPI and Powell and PPI tomorrow. There was really no reason to do that. You can find the stream this morning. I'm going to tell you right now, it's a you problem. Sorry. I don't send out the emails. I did that once, but it's in the course curriculum area, and it's also sent out on the STV Swing Kings Twitter. So I told you guys that a million times. Sorry for being snappy. There's been a lot of silly questions. You guys were asking me like over last week. You were like, where are the streams? Where are the streams? Where are the streams? I'm like, guys, I told you guys a million times I'm on vacation. Stop asking me where the streams are. There aren't any last week. I was on vacation. But the ticker list that I sent you guys still popped off. PayPal was a nasty one up above this level right here. Boom! Right to the upside. That was a dirty one. Rivian, I think, did really well as well for everybody. Yeah, Rivian, just nice slow grind up there. Now tell us about Forex. No. Absolutely not. So, yeah, I mean, if you guys are lucky enough to get a spot on the wait list when I do open up those spots this weekend, welcome to the team. If not, I mean, and you hop in later, you're just going to be subjected to a little bit of a higher price. But you guys see it every single day on Twitter and everything, how crazy the stuff we do is. So enough on that. See, we just missed you that much. I know, but the whole point is that you guys don't need me. The amount of messages that I got, especially, I think it was FSLR is a monster. It is. If Powell is pretty dovish and the market reacts positively, you could see 310 on this thing. You were able to get RKT closed in at 225%. Swing King strategy for the win. There you go, Yuki. Let's see. Oh, I see some slackers on the like button. Uh-oh. It's Powell that we got 7 minutes until the interest rate decision, ladies and gentlemen. Did I go fishing? I did not do any fishing. I mean, I know a lot of you guys saw the pictures of the jet. That was fun. That was a good time. The jet was cool. GM eating its way back up. ES not really doing anything. I mean, it's just kind of waiting around for the initial interest rate decision, and then we're going to be streaming the prepared remarks from Powell and the Q&A, which start at 2:30. Let's see what else we got here. Rumble now works with OBS. That's nice. That's very nice. Maybe we'll start streaming on Rumble too. Probably not. Probably not. The jet is not as cool as fishing. I don't know. I beg to differ there. The jet was pretty cool. FSLR moving down a little bit. Stream from yesterday. Check it. I can check it right now. I can check it right now. Nope, it's there. It's there. Let's see. Big lots. The next. No, we don't care about that. They're again. The Joker's Roaring Kitty. Which you should be focused. See, here's what I'm always shocked about this. It's like, if you could take advantage of these price movements right here, like an FSLR that's going to give you 250% gains, a GM, it's General Motors, like the 300% on GM, and we do this every single week. Why would you ever take on the additional risk when most of the time those stocks are going to pop, lock, drop, and not follow any sort of rhyme or rhythm, when you could just come and do that? Yeah, it doesn't make any sense to me. Like, that once you see it, you can't unsee it, and you have skills that literally nobody can ever take away from you. Let's see. Yeah, there you go, Daniel. Let's see. But yeah, for those of you guys that still need to grab that wait list, it's shortthevix.info. And then I'll probably be sending out an email to you guys going over some more details tomorrow evening. And then Saturday is when those emails are going to get sent out for when I'm allowing 10 people to hop into it. So only there's like 50 something of you guys on there. I'm not here to be like, oh, let's just get off it. No, no. Did I see Roaring Kitty has like 200 million in GME? Yeah, I'd be very curious to see how he got up there. Pop, lock, and drop. Oh, I've said that forever, but a TLT video where I went, dude. I haven't been over there since like September. I've been live streaming every day. Well, I live stream every day on YouTube until the end of May. And then now the streams for you guys are all private. All you guys in there printing money with Swing Kings and the day trading mastery strategy. There you go. There you go. And it's one-time fee too. Like, you'd have to be insane to not be like, oh, I can just get 350% plays every single week, and then you're good to go. So, all right, let's see. I mean, FSLR is moving around. This thing's been a gem. I'm down to like just runners on it. So I have the 330s for next week. If we see some more bullishness out of the market, great. If that expires worthless, I literally couldn't care less. GM, I'm out of. This was a really, really, really solid trade there, though. Really solid. 4 minutes, guys. Here we go. Make sure you guys are hitting that like button on the way in. Here we go. Yeah, guys, like, who cares about the Roaring Kitty stuff? It's fun to watch and everything like that, but like, it shouldn't be your main focus in the market because it's not going to help you make money over the long term. STV abandoned all. That's not true. That's not true. You need help finding the private streams? Francisco, if you follow the STV Swing Kings account, which you should be if you're in Swing Kings, the link is posted there. But 123 Sean Boat. I mean, this is just a one-off stream just for Powell. I mean, I'll probably be live for Powell once a month. But yeah, I mean, I'm going to be streaming 3 times a week for you guys that have taken advantage of those crazy deals I'm offering you with the educational courses and the watch list and the private streams. You blew another account, Wayne. How is that possible, dude? How are you doing that? I don't understand. Nvidia? No, it's AMD. I own an AMD at 1139. I sold like $16,000 worth of shares the day before, or the day of earnings, but it was before they reported. That was good. What does Papa Powell have for us today? A lot of good stuff, man. A lot of good stuff. Oh, we have 2 minutes until the interest rate decision. Here we go. This is gonna get interesting. Nah, Daniel, it shouldn't be possible. What days are the 3 streams going to be? They're Tuesday, Wednesday, Thursday for everybody. So, yeah, I mean, I can throw it in here. Shortthevix.info for you guys that need to hop on the wait list. Here you go. I don't think it's going to come up as a link, though, but you can copy that in. You just put your email in there, and then you wait for the emails to come to you. Let's see. What do you got? A minute left? 58 seconds. Here we go. Here we go, ladies and gentlemen. If Apple hits 222 today, you're going to Pierce. Oh, my God, dude. Yeah, Apple's been on a ripper. Just a ripper. Yeah, my FSLRs are still up 182%, but they're free. In the day trading one, it's not showing up. Well, it's in the Swing Kings one, it is. I know it's in there. Let me look at the day trading one. Did I only put it in one last night? I shouldn't have. I should have put it in both. You are correct. I only put it in Swing Kings last night. That's why it's posted on the Twitter account too for you guys. Which, when I say have notifications turned on, there you go. The courses are worth all the money. Got mine at 50% off. There you go, Josh. Yeah, I mean, the 50% off deal is over, but 33% will be this weekend. And then the prices will just continue going up from there until we get up to what they should be, which is the normal price of each of them separately. So There you go. Oh, here we go. Little move down. What do we got? What do we have? Come on. Fed keeps interest rates unchanged at 5.5%. That makes sense. Let's see. What else we got? Yeah, so we have unchanged. I'd love to see what the additional commentary is. Yeah, I mean, that's as expected. Fed holds bench. Yeah, why are people? I mean, I could sort of see why they're selling on this, but not really. Not really. That's an interesting one. Let's see. The budget, though? I haven't seen any other things come through the feed. Hold on, they're coming through. Fed officials raised 20. Oh, I told you the inflation target is getting. I mean, the long run inflation target is going to be not 2. That's just insanity. They're not going to be able to get it back down to 2. Voted 12-0 for Fed funds rate action. Okay, so all of them voted to not cut, not raise. Fed officials raised 2024 inflation forecast to 2.6%, up from 2.4% in March forecast. FOMC median forecast shows 100 basis points of rate cuts in 25 versus 75. So they're pricing in more cuts for 2025. That's interesting. That is very interesting, ladies and gentlemen. I'd love to see the dot plot. I would really love to see the dot plot. Now, FSLR down a little bit on that, but I mean, who cares? If that thing's gonna go, it's gonna go tomorrow. I mean, unless the market picks back up here and it starts to pop. Oh, here it comes. Here it comes. Let's see. What else we got on the feed? Anything? Fed inflation has eased over the past year, but remains elevated, which it probably will continue to be. $1,600 on NQ. There you go, Christopher. Let's see. GM is still holding up right around 49. That's nasty. Let's see. It shows 10. Whoa. This doesn't seem correct. I think this is nonsense here. Fed median forecast shows 25 basis points of rate cuts in 2024 versus 75. I think that's nonsense. FOMC median core PCE inflation estimate up to 2.8% versus 2.6. That also doesn't make any sense if PCE is going to remain at 0.2% month over month. So they're what are they talking about there? That doesn't make any sense. You're not CPU smart. Well, if you're not CPU smart and you can't use a computer in its most basic form, then you probably shouldn't be trading. And once you see how simple it is what I do, but how effective it is, you're going to be like, how have I not been doing this for my entire trading career? You're going to look at yourself in the mirror and be like, why was I being an idiot before? Like, Seer, anybody in here can kind of speak to that, where it's like, once you start looking at the swings this way, you're like, why wasn't I doing this forever? So let's see. GM chilling. FSLR still looking good. It's true. There you go, Tor. Yeah, Tor, you've been killing it, buddy. All right, so we got what, 26 minutes to go until what do you call it? Passing through. What up, STV? Not much, Nico. How you doing? Let's see. Yeah, let me see if I can grab an actual link for you guys. That might make more sense. So you don't have to go in and type it in. There we go. I think I got one now. I think this works. This one should work right here. Yeah, so there's the, let's see. Yeah, there's, all right, so now we have a link for everybody. So there you go. I mean, it's the best trading education that you guys are ever going to get. Golfing? No. It's been amazing, man. It's so grateful to learn from you and the others in here. Truly a blessing. Tor, that is awesome. On your trading journey. Wayne, the thing that you do is you over risk on stuff. and then you get frustrated, and then you do it again. That's what you do. I mean, I told you guys this morning how I size up for stuff and how I manage them. That was a gem. Those of you guys in the private stream this morning when we were going through that, how I kind of manage some of those swings in a slightly different way, that's gold right there. Absolute gold. Well, let's see. We got 25 minutes to go. Then we get to listen to Powell talk. That's going to be fun. That's going to be real fun. What is he going to have for us? All right, here. See, I just Nikki Leak says, to translate this, 4 Fed officials see no cuts this year. I just disagree with that. Up from 2 officials in the March projections. 7 see 1 cut, while 8 see 2 cuts. I think you have the probability to do. Well, if they did July and September, that'd be fine, and you're at 2 cuts. But if you start to see GDP growth slowing, a continued unemployment going up, the consumer data as a whole just showing that the consumers are incredibly weak, and you still see the pressures on the regional banking system and everything else, commercial real estate, you think they're not going to cut rates? Because at the same time, it's like, one, Bank of Canada and ECB, European Central Bank, have done it. Airbnb looking good. Yeah. I mean, I gave that one to you guys on the watch list this weekend. That was another one from the watch list that I gave you guys. Airbnb. Yep. You're welcome. Boom. I mean, I don't have it. That's not as good as the FSLR and the GM, but the GM was nasty. The GM was dirty. Your guesses say dots say September and November cuts most likely. Yeah, I think they're going to. It's just weird how they're not pricing in a sneaky July with the data. Because the Fed is basically getting everything they need to see in order to be like, all right, let's start cutting. Think about the jobs report in NFP. You can't have full-time jobs going through the floor, losing jobs, losing full-time jobs and adding part-time jobs. What does that tell you? Well, it means one, people are losing their jobs and trying to pick up part-time work, or the people that also have full-time jobs are taking on second jobs in order to meet their daily cost of living needs. Okay, so then extrapolating from that, the consumer is weak. All right, so the consumer is weak. You have GDP growth slowing, unemployment up, which is forecasted in those reports, inflation coming down to, well, not coming down, but decreasing year over year. And at the levels that it's at, if it stays here on a month over month basis, you're also going to see those inflation numbers tick to the downside from the month over month into the year over year. So they really need one more print, maybe, because you had CPI and everything heat back up. The thing that they're worried about, I'll tell you this right now, what they're actually worried about is that things like gold, silver, commodities, coal, oil, if they cut rates, they're worried that those rip. Because then the truckers, think about this, IYT, transportation. I mean, this thing has been in the garbage, absolute garbage, basically all year long. I mean, it's like flat on the year when everything else has been doing well. If oil prices go up, it costs them more money to transport goods. Okay, so if it costs them more money to transport goods, what are they going to do? Well, they're going to have lower margins and make less money. So that's kind of what they're worried about, oil. You know how you could solve that? We could drill. Just wanted to pop in and say, good evening, team. Here working, but up 90% on PLD. A-Rock, there you go. That's another one from the Swing Kings list. Every week, guys. I mean, you guys saw it when I was live streaming every day for all of you. The ones that I would call out on the streams, the ones that I would give you on the list, they're just filthy. Everybody always wants to buy stocks after they move. I don't know why. They're like, oh my God, look at how much higher it is right now. We should buy it. And it's like, no. You want to be buying the stocks right here before they go, or right here with GM. And it's so easy. Like once you see it, you're gonna be like, what? How did I not do this before? US is drilling more than it ever has. More drilling, and don't drain the SPR. How about that? How about that? Is there data people applying for unemployment benefits? Yeah, dude. Every Thursday, initial claims and continuing claims. We talked a lot about that in the mastermind too. GDP is going to be interesting at the next data release. Oh yes, it is. Oh yes, it is. I mean, FSLR just hanging out right around 300 here. Nothing crazy. I mean, I was in this thing right around 280. That's a nasty one. I do think that one has some upside. I mean, you guys saw me on the stream yesterday morning when we saw that little dip on FSLR moving to the downside here. I was like, I don't really care. Like this, I was like, I don't really care if this thing is moving down a little bit. That chart is just screaming at me to hold it. And then boom, there we go. Mike, there you go, buddy. Congratulations. And again, team, make sure you guys are hitting that like button on the way in. Helps out a whole lot with the YouTube algorithms over here. I've been posting a lot of YouTube videos for you guys too. On this channel, we're doing all the trading content. So if you guys haven't seen that yet, make sure you guys go take a look. Those are some incredibly valuable videos for all of you. We're going to have another one out tomorrow. I'm going to give you guys a little reversal strategy. It's pretty nasty. And then on the VIX Insights YouTube channel, which I think is linked in the description, I'll have a video out for you guys tonight. The first one where we're going to be talking more about like the broad market, macro, and things like that. Dot plots out. All right. Well, we kind of already saw that, right? Didn't I go through that? Like when I set, where was it? Fed projections. No. Yeah. 4 of 19 officials saw no rate cut in 24. 7 saw 1. 8 saw 2. That's the dot plot. All right. Oh, here comes FSLR again. Hey, buddy. Hey, pal. You want to print me more money? I mean, guys, it's like, it's like, are those videos for the public or private? They're out publicly on the channel. That's why I say make sure you guys have notifications turned on for the YouTube channel so you guys don't miss anything. I'm trying to do 2 trading videos a week for you guys on here. Let's see. And then 1 or 2 on the VIX Insights channel because you can't really do it all in one. You send a DM. What is it? The dots show that in March there were 10 Fed members who saw rates at. Now there are none. How? I don't understand what the Fed is seeing. You know, like Ralph, looking at this data right here, that doesn't make any sense to me. How do you go from like, okay, GDP growth is slowing, unemployment up, inflation data coming down, and you saw 10 Fed members who saw rates at 4.625 or lower by the end of 2024, and now they're none. They're pushing out expectations. That doesn't make sense to me. We've seen that a lot recently where things start to not make sense for no reason, and then they snap back. Here's another thing. The dot plot, it's very possible that the dot plot that we're seeing right now is already out of date. Why? Does anybody know why the dot plot, this data coming out right now, it could be out of date and is pretty much irrelevant to what we're seeing in the market right now? Why do you think? I could just tell you. 4.7 or more in unemployment. Yeah, that's crazy. That's craziness. They're just gonna like just slaughter the everyday American consumer. All right. The reason why the dot plot could be out of date is because they had their closed door meeting yesterday and we had CPI this morning. So unless they went in and made revisions off of the new data, this is off of all the last rounds of data that we saw. But also, it doesn't make any sense that all of the things that we've been talking about that you would just be over here expecting, oh yeah, no, we're not gonna be like we're just gonna say, nah, let's just slow GDP growth, let unemployment go up and inflation come down, and just put the brunt of the burden on the everyday American consumer. Sounds good, right? Yeah, okay. Like that's effectively what the Fed is. From these statements, that's what the Fed is doing, which is pretty nuts. That's pretty crazy. So where's ES right now? It's just kind of hanging around. I mean, FSLR at one point lost 300, I think, and then came right back up. If this market off of Powell's statements start to pop, you could see 310 today on FSLR, but I don't think today is going to be the day for it to happen. Just because the market's already up 0.9%. Could be tomorrow, could be the next day. We do have PPI tomorrow, which is the producer price index. That's going to be an interesting data point. Not as big as CPI, but still a big one. It's a cost that producers are witnessing. We've seen some interesting discrepancies in those where PPI was coming down, but the prices at which products were being sold were going up. That was a weird one. So FSLR back up to almost 303. That's good. GM looking good. What else? Where's PLD? How's that looking? I mean, it's still up 2.29%. The entry on this one was right around 1106. I know you guys were killing it on that. When this thing popped up here this morning, I mean, I was getting so many messages like, oh my God, I'm up to 180, 200% on PLD. It was ridiculous. But the best one from this week so far is GM. I think what did I have? I posted the screenshot for you guys somewhere. 305% on the GM calls. That was filthy. All right, 15 minutes to go until Powell, ladies and gentlemen. Let's do it. Let's do it, man. This is going to be fun. Yeah, and then for those of you guys filtering in right now, I mean, the private live streams have started. The 50% off deal is over. This weekend, if you guys are on the wait list to hop in, because I mean, I tell all you guys, I'm always available to anybody that hops in, answering all of your questions. Actually, those of you guys that are in the live chat right now, tell the other people on the outside how fast I am at answering all of your guys' questions all the time. A lot of my day is spent looking at questions from all of you just to make sure that everybody understands, going over ticker strategy, risk management, and psychology with you guys to make sure that you guys understand. So I'm not going to raise prices on anything, but there is a wait list. There's about 50 of you guys on there right now, and I'm only going to be letting in 10 of you guys this weekend. So 10 new people are allowed to hop in. So I have the link somewhere. I think I could throw it in the live chat again. All you got to do is put your email in there. I'll have an email that'll go out probably tomorrow night, giving you guys some more details about everything. Again, you guys get access to both of the educational curriculums. You get the 3 private live streams a week, the list of stocks that are about to explode before they do. You can't go wrong, man. You really can't. So I have not had a question go unanswered longer than an hour. There you go, Todd. There you go. And there's like hundreds of you guys in there too. That's like I've asked about tickers, and no joke, he is back in no more than 5 minutes. Unreal. Yeah, I got you guys. But in order for me to continue doing that, I have to waitlist it so that all of you guys can always have your questions answered. All right, FSLR back up nicely there. That's nice. It's impressive. Not sure how he does it. I told you, I see the future. That's why I can find these stocks that are about to explode before they do so often. I'm a time traveler. So I know when you guys are going to send me the messages. I just say, hey. I'm not a time traveler. I'm just good at this. That's it. And I always want to make sure that you guys have your questions answered. Is the mastermind on waitlist? In Japan, no. So if you do want I can throw the link to the mastermind in here. I think I have it. The mastermind is the only thing that's not waitlisted. So if you really want the mastermind and you want access to if you want it quick and don't want to risk not being able to get in on the wait list, you can, what do you call it? Here it is. Here's the link. You can hop in, but you don't have to. I don't care. Like, having a wait list the way you need to is like having too many girlfriends that need messages all day. Makes sense to me. It's true. You guys are all my girlfriends. I'm just kidding. One time he messaged me the answer before I even asked it. Yep, that is what I do, ladies and gentlemen. All right, FSLR coming back up. That's nice. Can you see into the future if the Fed can get their heads out of their asses? Yes, they don't. The Fed does not get their head out of their ass. Sorry. That's going to be the case. Rivian back down, PLD coming back. What are yields doing? This is crazy. Remember how we talked about TMF, TLT, all of these? I got you guys in on the TMF and TLT down in here. So ran up nicely, came down, coming back up, still very green. There. Yeah, Trev, I know. That was a funny one. Yeah, so the lucky 10 of you guys that are able to hop in this weekend, you guys will have access to get all your questions answered, go through the videos, get the watch list and everything. So we'll get you guys going. The deficit sure seems like they need to cut sooner than yeah, but you can't. Triffin, we talked about this in one of the VIX Insights research reports. Triffin's dilemma: they have to run a deficit. It's impossible for the United States to not have a trade deficit, unless you're referring to something else. But they cannot. They have to have a trade debt. Apple new highs. Oh dear. Oh dear, Apple's a nasty one. I told you guys, I got that text when we were on stream yesterday where my buddy was up 130% on Apple contracts. And he was like, what do I do? I was like, sell a little bit. Let's see. But you're right, I shouldn't be trading. Hot mess. Here's the actual interesting thing about this. It's so easy. I know you could do it. The setup in the system is so simple, and it's crafted so that all of you guys, it takes like away all of the beginner mistakes that like new traders make. It makes it so simple for everybody to understand. It's like, and that's the thing when I say like when you first time you see it, you can't unsee it. You're like, oh, it's that simple. Yeah. Stop trying to overcomplicate things and do a bunch of nonsense. Okay. All right, we got 10 minutes to go. Let me start getting this Powell link up somewhere. Good afternoon. Dude, I wish we could hear Janet Yellen talk sometimes, you know? This is the wrong video, I think. Nope. We're good. All right. Let's see. Coin. I mean, I haven't traded coin, I don't think, till I gave you guys the 500%er down here. This was a nasty one. I don't really see much on this chart that I like. So, probably not going to be touching this one. What about like Mara, MSTR? No. This was nasty. Guys, this one was filthy. Oh my god. That one was a really good one. This MSTR, that was fun. What else? I mean, there's a couple of other things that I'm looking at. I mean, we're not going to talk about them here, but there are a couple of other tickers that I'm very excited about, especially with the where the market is right now. The watch list over the next few weeks could be, I mean, I was up to what, 36% last month. We've had some crazy runs, and they're just going to continue. It just depends on where we're going to have to look for them. That's it. Like we had that one stretch of time where all I was trading was like Biddy, DRV, what was the inverse like Faz? There were a couple of other ones. TBT was kind of in there for a bit, but those were all good ones too. All right, folks. What are we gonna get? Where's GM? How's that doing? Is anybody still holding the GM? Because that one was pretty nasty. Is anybody still holding that? That was the one that I found Monday at like 6 a.m. And I was like, add it to your watch list. Same thing with Ford. Ford was good. Ford was good on this day here. I was able to make this free and then sell a little bit more at the end of the day when this thing started knifing. And then at open yesterday, I was out of the rest of it. So happy about that. That's actually setting up again. So that could be interesting. But with GM, we got that buyback news, which was definitely helping us out. Is anybody still holding the GM? I'm out of it. I was out of it yesterday. I think I sold the rest of them around like 220%. Palantir's not following along today. Palantir hates me. It will not give me sub 20. Do you usually look for stocks on Sundays? Well, I look for stocks every day, but when I go through the watch list, like and create the watch list for you guys, I mean, I'm looking at them like Friday, Saturday, Sunday, but I scan through like 3,000 tickers for you guys every weekend. That's why like the tickers that I give you are the best looking ones. So there's usually like like 2 or 3 of them in there every single week that go absolutely ballistic. So, yeah. You were out at 178% on GM. Todd, that's awesome. Also, Todd, shout out to you. I think this was you that sent me this message. Last week when I was on vacation, you were kind of trading on your own, seeing if you could do it on your own, and you were nailing it. You had like what, 3 or 4 winners. All of them were above 85% gains. That's awesome, man. That's the point. Giving you guys the tools that you need for long-term success. That's what it's all about. You didn't even need me. Well, PayPal was nasty. So if you traded PayPal, you got to thank me for that one. But other than that, if you crush any of the other ones, there you go. FSLR doing nothing. We got ES screwing around. It's going to be in a big range. Let's see. Anything else coming through the feed? Jay is tweeting something. Hold on, I like this. 2024 median GDP growth, 2.1%. I'd have to take a look at some of those numbers to see if I agree. What else is on here? 2024. Yeah, see, this is what I think is nonsense about this, which I also think the market should be selling. if this is actually the case. And I think the market's calling BS. 2024 median Fed funds forecast 5.1% versus 4.6. So they're pricing in that all of the cuts are going to happen, or the Fed is basically saying they think the vast majority of the cuts are going to happen in 2025. I don't think that. I think you're going to get two this year. Yeah, I think you're going to get at least one. Because what they're essentially saying is we're only expecting one rate cut this year. Well, when does it happen? Are they going to leave everybody struggling up until the election, basically? You didn't get in PayPal, and yes, that was me. Last week was a total validation that I can do this. Todd, that's what I love to see. Yeah, seeing your guys' messages all the time about how much success you guys have been having, especially for those of you guys that I've seen struggle for a few years. Getting you guys in the swings like this is just like you. Once you see it, you're like, holy, sorry for my language, shit. All right, what are we looking at? I mean, we're probably just going to be mainly focusing on ES for this because I'm not going to be trading anything. It's Powell. You'd have to be an insane person. I mean, I have had a really good week, so I can afford to take a little risk if I want to, but there's no reason for that. I mean, I'm up over what 5.5% this week. The great thing about the watches is that you can take a few of them or go bigger on one or two and just be done. Once you see it, you truly can't unsee it. Look at FSLR since like 9:50 on Monday. Kimberly, I know that one was a gem. Boom. I actually should have, and we talked about this. I should have tried to get it off of the 10. I should have tried to front run it down in here at 268. My entry was 280. Think about what those contracts would be looking at like right now if I got this at like 268, 270 versus 280, and I bought the same ones. They'd be up 400-500% right now. So I just waited for it to confirm. But that front run, I think Daniel front ran it. And he got out early, but he still had some really nice gains on it. So that front run in there was just like it reminds me of the AMD front run that we did back in here. This one. It reminds me of this front run. This one was filthy and then blast off. So we're just gonna keep doing it. Printing money for people. Let's see. FSLR pre FOMC made sense. I missed it off the 10. I wanted it off the 10. I wasn't really paying attention because remember I had GM and forward cruising. I didn't even really want to take you front right. Oh, 30%. That's still good. I didn't really even want to take the FSLR. I sized it a little bit lower, but still nicely. Oh, and yes, I remember that you re-entered because you had the 300s for this week, and then I think you got like the 320s for next week or something like that. Wait, Tesla's at 180? What the? Dude, I hate this chart. I hate this Tesla chart. All right, so I guess the weekly setup is sort of valid now. I don't know. I don't really like the vote. Isn't the vote today on Tessie? I think so. But all right, guys, we got 2 minutes to go until Powell starts speaking. I'll throw the link to let's see, where is it? I'll throw the link to the wait list to get in to get all those private streams, the list of stocks that are about to explode before they do, the hours upon hours of educational content for you guys in there. So again, I'm only letting in 10 people this weekend. The 50% off deal is over, but I know I'm being too nice, but I'm still going to give you guys 33% for the 10 people that are going to come in this weekend. But whenever I do open up spots again in the future, it's just going to be higher. So if you get in this weekend, great. If not, I mean, you're going to miss it and going to have to pay a higher price in the future. Because they are heavily discounted. So there you guys go. All you got to do is put does the mastermind include everything? Okay. Yes, it does. But once you hop into the mastermind, you got to send me a DM and then I send you a code to get the courses for free. That's been some confusion with some people. But yes, it does. You just have to then message me once you do it, and then I'll give you the both the courses for free. So, whoa, FSLR, there we go. Moving up. What are these contracts at right now? Oh, 201%. Thanks. And then we actually might do a mastermind round 2 at the end of the summer. Add some content to it. Right now, there's like 20. It probably comes out to like 17 or 18 hours of content in there with the mastermind for you guys. But let's get Powell on here. Is he on yet? All right. Hold your horses. We're going to have to play a little game called Can You Hear Powell in a minute here. Let's do it, team. Where is this? All right. I'm waiting for the door to open, and then we're going to get Powell on here. This is going to be a fun one. I hope you guys are excited for this. This is going to be a very, very eventful FOMC, I think. I think he's going to say some. Oh, he's here. He's here. I see him.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace.
What?
Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter.
He's cherry picking.
The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Here we go. Here we go.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end.
Yeah.
It's already 2.75. And after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month.
Yeah.
Does that tell you that the average official expects no further progress in inflation?
Great question.
And in fact, that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah,
That's an awesome question.
What's going on there is that we had very low readings in the second half of last year, June through December, really. And we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window.
Yeah,
So
month over
it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and then hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE.
That's the point.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast month by month that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Timmeros of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings like the one that we saw this morning make a September interest rate cut possible?
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the dot plot, their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls, but we ask them to write down the most likely one. So they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all of them as plausible, but I'd look at, I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it that is on the committee a really strong commitment to a particular rate path. It's actually just their forecast and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly more good inflation readings will help with that. I'm not going to be specific about how many because, really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response, which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers
good question. I like
today?
So this happens too often, but it does happen. It just is, data came, I think it happened a couple of meetings ago, a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. And I'm not going to get into the specifics, but you have the ability to do that. So that what's in the SEP actually does reflect the data that we got today, to the extent you can, reflect it in one day. I think you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its, kind of first level translation to PCE, we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
Janelle.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing, mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit. And that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still, they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully. And that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand. And that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago, or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. How can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier in the, what did we take away from this? We had really, really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year, take place next year. You know, there are fewer rate cuts in the median this year, but there's one more next year. So if you look at year end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. You know, the economy has, you know, repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina. Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed. And what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today, we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were, you know, very low by recent history measures. Now, we can't really know that. That's an interesting dispute and discussion to have now. But ultimately, we think that things like the neutral rate are driven by longer run, slow moving forces. And, you know, there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate. And we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And, you know, my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having, you know, the effects that we would hope for.
Well, thanks, Chair Powell. Howard Stein with Reuters. Just to carry that a little further, should we read this as a conclusion that the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about, you know, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You know, you can translate it into the language you're talking about, but to me the focus is more on, we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal. And then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And I think we think, yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that is going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that though. We're look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. But so that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation with growth at a good level and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market while we're continuing to make progress on inflation. So we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. Ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and we've taken some signal from that, but. And of course, housing services, you're continuing to see high readings there. To some extent, that's catch-up inflation from earlier pressures. But overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy? What you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about it at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully, and we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably down 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Jolene.
Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
Good question.
I don't think anyone knows has a definitive answer why people are not as happy about the economy as they might be, and we don't tell people how they should think or feel about the economy. That's not our job. Where people experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had, a long stretch of time with unemployment at or below 4%. Very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year. And I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, particularly the second half of last year, and we continue to see still strong growth or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that. And that's not what happened. Instead, the U.S. is anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents. It has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It just is going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does. And it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward.
Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home, but households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as a spending or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but
it's still, all on credit.
It's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But no, you're right though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done. Ultimately, to get inflation under control, because those people experience inflation, very directly, very painfully, and once we get inflation under control, rates can come down, which will also improve things.
Victoria.
Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move and to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So and also the fact that we look at all of the whole situation. So a decision to begin to loosen policy could have several reasons associated with it at a given time. But I would just tell we monitor all the labor market data, and if we saw troubling weakening more than expected, that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I mean, I can think of things many things would make it on that list, but I don't think I'll butter them here.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I get that, as many good ones as we had bad ones, but no, it's not like that. It's going to be the totality of the data, the labor market data, the growth data. In terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things because that points to dates, and I just don't think we're not at a point of being able to do that.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that markets should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't, actually it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, and for our economy, what we're trying to foster is maximum employment and price stability. And we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE. We're at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation.
So we're well aware of the two-sided risks here. Let me just say we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there, and we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low. So we have the ability now to approach this question carefully, and that's what we're doing.
Just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Evan.
Oh, Nikki Leaks.
Thank you, Chair Powell. Evan Reiser with Market
Just
News
kidding.
International.
That's-
You have mentioned
that made no
before the
sense.
framework
That was a
review
brain
process will start in the
there.
latter half of the year. At this point, do you have
Never
any
mind.
specific time frame for the start of that?
I thought we were getting
Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing and all the other details. We don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't, there isn't any one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example. And we don't target wages. We target aggregate prices and overall employment. So,
But if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you look at we'd be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
All right, ladies and gentlemen, that was a wild Powell presser there. There were a lot of good questions. That was probably the one presser on the FOMC meeting that actually had a lot of really good questions. But typically Powell will respond in I hate to say it this way, but like a coherent way. And in this way, he's basically just like, I don't know. Because the Fed has been coming out and giving a certain level of guidance. And then all of a sudden we hit those metrics. And then Powell's like, oh, just kidding. We need our confidence levels to go up. And the reporters are like, well, what do you need to see? And he's like, well, our level of confidence, it has to go up. And it's like, well, but what do you now need to see? And it's like, you didn't hear me. Confidence go up. It's like, all right, guys, what are we doing here? So team, I'll have a video breaking a lot of this down for you guys and some other things that are happening on the VIX Insights YouTube channel tonight. For everybody that still needs to hop in on the wait list to get access this weekend to one of those 10 spots that I'm going to be opening up for all the 3 private streams a week, the watch list of stocks that are about to explode before they do, all the hours and hours of educational content and having basically one-on-one access with me to be able to ask me any questions that you guys have. And again, I extend that to you guys to make sure that you guys understand how powerful you understand how to actually implement these strategies because of how powerful they are. I mean, I've taken 3 trades this week. GM's a ripper. Ford was an amazing one. And FSLR is still looking really, really, really solid. So we're just going to keep doing it, man. If you guys missed this, remember, there's still going to be about a 33% discount this weekend. But after that, I mean, the prices are just going to continuously move to the upside. So if you want to hop in, don't miss it. Or if you're fine with paying a higher price later, that's okay. So team, I will see you guys later. Again, I'll have some more trading videos out for you guys tomorrow on this channel. There's, I think, 3 out for you guys right now. If you guys haven't seen those yet, make sure you guys go watch those. Those are going to help you guys out a whole lot. Nobody do anything stupid. I took no trades today. The only thing I did was scale out a little bit more of the FSLR. Those of you guys that are going to be attending the private live stream tomorrow, we're going to do a lot of ticker hunting, kind of setting ourselves up for what we want to see going into next week and how the overall market is going to be reacting to what Powell has said today. And what do you call it? And how PPI goes tomorrow morning as well. So team, I'll see you guys later. Again, make sure you guys hop in on that wait list there. You just got to put your email in. We'll have an email out for you guys tomorrow night, breaking down a little bit more of the details of what you guys are going to need to do. Very simple. Just kind of go through everything that you guys are going to be getting. Less trades, more profits. Once you see it, you can't unsee it. There you go, Kimberly voice. I might for a little bit. If people are in there, I'll do that. But team, I'll see you guys later. Peace.